Welcome to the Deep Dive, where we cut through the noise to bring you the most important nuggets from the world of business and finance.
Glad to be digging in today.
Yeah, today we're taking a look at National Fuel Gas Company's Q3 fiscal 2025 results.
NFG, right. And this isn't just, any company. They're a big player integrated across the natural gas value chain.
Totally. From exploration, pulling it out of the ground, to pipelines, getting it moved around, and even the local utility delivering it.
Covers the whole spectrum.
So our mission today is really to unpack what happened last quarter, get a sense of management strategy moving forward, and, well, figure out what it means for you.
And there's this interesting little puzzle right away. The market didn't exactly jump for joy after the results came out.
Right. Kind of a muted reaction, a bit of a shrug, even though some of the operational numbers looked, frankly, pretty strong.
So let's dig into that. Why the disconnect? Let's see what's really under the hood.
Okay, so the results snapshot. What did the top and bottom lines look like?
Well, it was definitely a bit of a mixed bag, like you said. On one hand, their EPS earnings per share came in at $1.64, both GAAP and adjusted.
Okay, $1.64. And how did that stack up against expectations?
It actually beat the consensus estimate quite nicely. Wall Street was looking for about $1.53.
So a solid beat on the earnings front, about 7% better than expected.
Exactly. But then you look at revenue. That came in at $531.8 million.
Which sounds like a lot, but...
But it missed the consensus forecast, which was closer to $599.3 million, so a revenue miss.
Ah, okay. So earnings beat, revenue miss, the classic head-scratcher. Still, that adjusted EPS number itself, didn't that jump quite a bit from last year?
Oh, absolutely. It was up a massive 66% year over year.
66%. That's huge. That suggests some serious operational leverage, even if the total revenue didn't quite hit the mark.
It really does. And when you look at the operations, you see why. Their E&P segment, Seneca Resources, they hit record production.
How much are we talking?
112 BCF. That's billion cubic feet. Just a massive volume. And it was up 16% compared to the same quarter last year.
Wow. Okay, record production. And were they spending a lot more to get it?
Actually, no, that's the other impressive part. Their total cash operating costs for E&P dropped down to just $0.91 per McCalf.
91 cents per 1,000 cubic feet. That's incredibly efficient.
Top tier cost control, definitely. And they generated good cash flow, too. Operating cash flow minus their investing outflow was positive $196 million for the quarter.
So generating cash internally, controlling costs, boosting production. A lot going right operationally.
For sure. But you combine that with the revenue miss, likely tied to, natural gas prices not being maybe as high as some models expected for that revenue calculation.
Right. And that mix seems to be what caused that initial slightly negative reaction from the market.
Yeah.
Investors were probably processing that top line miss, thinking about gas price assumptions going forward.
Makes sense. So let's dive deeper into the segments, starting with that strong upstream performance from Seneca.
Okay, Seneca Resources. Record production now. But what about looking ahead? Are they keeping the foot on the gas, so to speak?
They are, but in a really efficient way. For fiscal 26, they're actually guiding for another production increase, about 6% at the midpoint. They're targeting 440 to 455 BCF.
Okay, more growth. But here's the kicker I saw. They expect to do that while spending less capital.
Exactly. About 4% lower capital expenditures compared to fiscal 25.
How do you get more gas for less money? That sounds like finding a cheat code.
It's all about capital efficiency. A huge driver here is something they call their Gen 3 well design.
Gen 3. What's special about it?
It's a pretty significant innovation, apparently. They're seeing 25% higher estimated ultimate recoveries. That's the total gas they expect to get over the well's life, and higher cumulative production early on in their Tioga, Utica area.
So there's better well technology, getting more out of each spot they drill.
Pretty much. And that directly translates to lower drilling and completion, or DNC, costs per foot. So overall CapEx comes down even as production goes up. It's smart.
And that really helps cement their reputation as a low-cost operator in the Appalachian Basin, right?
Right.
They talk about having decades of drilling spots lined up.
They do. And they even had an independent group, Enverus, validate that inventory. Having that deep bench of high-quality, low-cost locations is a massive advantage, especially when gas prices are volatile.
Definitely provides some resilience. But speaking of volatility, how are they managing the price risk on all this production?
Good question. They've got a pretty robust hedging program. About 2/3 of their expected production right through fiscal 26 is locked in somehow.
Using what kind of tools? Swaps.
A mix. Swaps, fixed price sales, and also collars. Those collars are interesting. They set an average floor price around $3.50, so they have downside protection.
Okay, protects against a price collapse.
Right. But they also have a ceiling averaging around $4.75. So they still get to participate in some of the upside if prices really take off, but they give up the extreme highs.
A balanced approach then. Protect the downside, keep some upside potential. Makes sense.
Exactly. Risk management.
Okay, so that's upstream. Now, let's shift to midstream of the pipelines. They seem to be focused on growth there, too, connecting supply to new demand.
Yeah, definitely. They're highlighting two big projects. First is the Shippingport Lateral.
Shippingport. That sounds familiar. Power plant.
Exactly. It's about a 7-mile pipeline expansion to deliver gas, about 205,000 decatherms a day, to the Shippingport power station. And interestingly, also to a data center being built right next door in western PA.
A data center. That's a big theme now, the power demand from those things.
Yeah.
When does that project come online?
They're targeting the fourth quarter of calendar year 2026 for service to start.
Okay, so a couple of years out. And the second project.
That's the Tioga pathway.
Great.
This one's already got the green light from FERC, the regulators.
Good. Cuts down on uncertainty.
Right. And this pathway is designed to give Seneca's production from their eastern development area a route to markets where prices are typically better, more premium pricing.
So better netbacks for their gas. When does that one due?
Early fiscal year 2027, so a bit after Shippingport.
And together, these aren't small potatoes, revenue-wise.
No, management expects them to generate over $30 million in new annual revenue combined.
30 million plus. That's what, maybe 7% of their current pipeline and storage revenue? A decent bump.
A noticeable contribution for sure. And construction for both is planned to kick off in the first half of calendar 2026. So we should see activity soon.
And it sounds like the timing is pretty good, regulatory-wise and demand-wise.
Seems so. They mentioned FERC actually increased the cost limits for certain types of projects, which helps speed things up a bit. And the demand side. Yeah, especially in Pennsylvania.
The data centers again.
That's a huge part of it.
Yeah.
Management cited this figure, over $90 billion of new investment announced for data centers just in Pennsylvania.
90 billion. Wow.
Yeah. And NFG, with its pipelines and gas supply right there, feels uniquely positioned to capture some of that demand. They're also looking to connect with other producers to use their existing pipelines more, third-party opportunities.
Smart. Leveraging the assets they already have. Okay, so growth in upstream, growth in midstream. What about the steady eddy, the regulated utility business?
Right. That's kind of the anchor, isn't it? Provides that stability. And it's still growing consistently. They expect mid-single-digit growth in their rate base, the assets they earn a return on each year through the end of the decade.
Predictable, regulated growth. How are they achieving that?
Mainly through system upgrades, modernization, and getting those costs approved in rate settlements. For fiscal 26, they see a 5-6% bump in utility customer margin.
And where is that coming from specifically?
A big chunk is from a 3-year rate deal they already have in New York, plus ongoing recovery of modernization spending in Pennsylvania.
So locked-in growth from the utility side, providing a nice counterbalance to the more volatile E&P segment.
Exactly. It creates that balanced sort of all-weather business model they talk about.
And are they planning more rate cases soon to keep that growth going?
Yes. They mentioned they're thinking about a rate case for their Supply Corporation pipeline in fiscal 26, though the revenue impact wouldn't hit until early fiscal 27. And also a Pennsylvania utility rate case filing next year, aiming for new rates, also effective early fiscal 27.
So constantly working with regulators to update rates and reflect investments. Standard utility practice, but important for that steady growth.
Absolutely. And speaking of financials, there is some interesting news on the tax front, too.
Oh, yeah. What's happening there?
Recent federal legislation seems to be giving them a nice boost, specifically bringing back 100% bonus depreciation and some changes to how the corporate alternative minimum tax, the AMT, works.
And the bottom line impact? Lower taxes?
Significantly lower cash taxes. They're projecting cash tax rates in the high single digits for fiscal 25, dropping even further to mid-single digits for fiscal 26.
Wow, that's quite low. A big improvement from what they might have expected before.
Definitely a notable improvement, yes. It frees up a lot more cash flow internally.
More cash. Which brings us to capital allocation. How are they using it? Rewarding shareholders.
Well, they have a very long track record there. They just raised their dividend again in June. That's the 55th year in a row.
55 consecutive years. That's dividend aristocrat territory, isn't it?
It certainly is. The new annual rate is $2.14 per share. And that dividend is largely supported by the cash flows from those stable, regulated businesses we just talked about.
Makes sense. But what about share buybacks? Weren't they doing those?
They were, but they've actually paused the program temporarily.
Paused. Why? Is that a bad sign?
Management framed it very clearly. They said it's to keep the balance sheet flexible and really prioritize evaluating these new growth opportunities we've been discussing, the pipelines, maybe other things.
So growth first, buyback second for now.
Seems to be the message. They did add that they expect to finish the existing buyback authorization in 2026 if these big growth investments don't fully materialize. So the commitment is still there, just sequenced after growth.
Okay, a strategic pause, not a cancellation. Got it. Let's pull back now, look at the bigger picture. How do things like overall natural gas market trends and, energy policy shifts play into NFG's story?
They're huge factors, obviously. Management sounds pretty positive, constructive on the outlook for natural gas prices overall.
Why? What are they seeing?
Strong fundamentals, basically. Demand, both here in the U.S. and internationally, is hitting all-time highs. You've got record LNG exports pulling gas out of the country.
Sending it overseas.
Right. And also record levels of natural gas being used to generate electricity domestically. Gas-fired power generation is way up.
So the narrative isn't just gas as a bridge fuel anymore.
Their view seems to be stronger than that. They talk about gas being a foundational fuel for decades.
Yeah.
It's underpinning economic growth, power reliability.
Interesting framing. And what about the policy side, especially in their key states, Pennsylvania and New York?
That's also evolving. In Pennsylvania, there seems to be a real pro-energy, pro-development push. They mentioned an energy summit highlighting that massive $90 billion investment pipeline, especially for data centers. The state seems eager to leverage its energy resources.
Which plays right into NFG's hands with their integrated assets there.
Exactly. And then in New York, things might be getting a bit more pragmatic.
Pragmatic how? New York's been pretty aggressive on climate goals, right?
They have. But the state's latest draft energy plan apparently acknowledges they're likely going to miss some of the interim targets set back in 2019.
Reality setting in.
Perhaps. The plan seems to suggest a more all-of-the-above approach now, recognizing that they still need to invest in the natural gas system for reliability and affordability, even while pursuing decarbonization.
So maybe less of a hard stop for gas infrastructure than previously thought.
That seems to be the signal, yeah. A potential shift towards a more balanced energy transition.
Okay, so you put the strong demand, the supportive policy in PA, maybe a more pragmatic approach in NY. It does seem to bolster that foundational fuel argument.
It builds a compelling case for their core business long-term, for sure.
So let's bring it back to the investor context. What are the key things you listening should take away from all this?
Well, one really critical point is just how sensitive NFG's earnings are to natural gas prices, especially looking out to fiscal 26 based on their preliminary guidance.
How sensitive are we talking?
It's a huge swing. At $3 on YMX gas, they project EPS between $6.35 and $6.85. But if gas prices go up to $5, then the EPS projection jumps to between $9.75 and $10.25.
Wow, that's almost a 50% increase in potential earnings. Just from a $2 move in gas prices. That's serious torque.
Massive leverage to the commodity, yeah. But even with significant growth spending, they're still projecting strong free cash flow, around $350 to $400 million at a $4 NYMEX price.
So they can fund the growth and still have cash left over.
That's the plan. The whole strategic narrative they're pushing is this shift towards disciplined growth, leveraging the integrated model for cash-efficient growth and regulated expansion.
That all-weather setup with upside phrase they used.
Exactly. It sounds confident, positioning for stability with potential upside if gas markets cooperate.
So what are the key things to watch for that will tell us if this narrative is playing out?
Definitely watch for their formal fiscal 26 guidance when it comes out. Keep an eye on the actual start of construction for those big pipeline projects, Shippingport and Tioga Pathway, expected in the first half of calendar 26.
Okay, project execution.
Right. Also, the outcomes of those upcoming rate cases we mentioned, and of course, the big one where natural gas prices actually head over the next year or two.
That macro price trend is always key for energy stocks, which brings us back to that initial puzzle, the muted market reaction.
Yeah, it seems investors are maybe acknowledging the strong operations and the future potential, but they're also weighing that Q3 revenue miss and maybe need to see more concrete proof. Proof like sustained higher gas prices actually hitting the bottom line, or clear progress on those projects, before fully buying into the growth story.
Waiting for the future potential to become current reality. Makes sense.
Yeah, show me story, perhaps.
All right, and that leads us perfectly into our "This is not financial advice" segment. Let's toss around an idea.
Okay, but the big disclaimer first. This is strictly for entertainment, food for thought. It is not financial advice. Please always do your own research.
Absolutely. So, with that bright flashing warning sign, what's an outrageous but plausible idea related to NFG?
Okay, think about that massive earnings leverage to higher gas prices we just discussed.
Yeah, the $3 is $5 swing.
Right, and think about their hedge book. It protects the downside, but still allows some participation above that $4.75 average ceiling. Plus, you have this potentially explosive new demand from data centers in their core area.
Okay, putting those pieces together.
What if you considered long-dated, deep, out-of-the-money call options on NFG stock? Maybe expiring late 2026 or early 2027.
Deep out of the money calls. So cheap options that only pay off if the stock price really surges.
Exactly. It's a high-risk, potentially high-reward way to play a specific thesis. The thesis here is that structural demand data centers, LNG exports, actually pushes gas prices sustainably above NFG's hedge ceilings over the next 18-24 months.
So if gas goes to, say, $5 or $6 and stays there,
then the unhedged portion of their production, plus the bit they capture above the ceiling on the hedged part, could lead to earnings blowing past current expectations. The options provide leverage to that upside surprise without tying up as much capital as buying the stock outright.
the outrageous part is betting that natural gas prices defy the current future strip, which isn't predicting that kind of sustained rally. Right?
Precisely. It's a bet on a structural shift in the gas market, overpowering the near-term forecasts. Highly speculative, hence the outrageous but plausible tag.
Interesting idea. Again, not advice, just a thought exercise. Okay, let's wrap this up.
Sounds good. So National Fuel Gas Q3 showed really strong operational performance, wouldn't you say?
Definitely. Record production, impressive cost control, clear plans for growth with those pipeline projects, and the Gen 3 wells. A solid operational story.
Yeah, despite that revenue miss that seemed to puzzle the market initially, they're clearly laying the groundwork for capital-efficient growth across all parts of the business, upstream, midstream, and the utility.
Absolutely. The picture they're painting is one of building real momentum for the long haul, leveraging that integrated model.
So for you listening, key things to track are that regulated rate-based growth, the impact of those lower cash taxes, the progress on the midstream projects.
And crucially, the path of natural gas prices. That remains the big variable with significant leverage here.
Couldn't agree more. Well, thanks for tuning into the deep dive. We hope this breakdown helps you think about how all these pieces fit together for NFG and the broader energy picture.
For sure. And as always, we encourage you to dig into the company's report yourself. There's always more detail to uncover. Thanks for listening.